Hello, dosto. My name is Deepak, and I'm a tax code advisor. And today I'm going to talk about a couple of financial decisions I took today. And why did I make those decisions? What my thought process behind those decisions? I'm going to share it all with you. Number one, I sold out of Celestica, and I'll share why did I do that. I like the company. It's still growing. It still have a lot of support. So I like the company. Still, I decided to get out of it today. So I'm going to share some of my reasons behind that. And second is Root Insurance. And I was thinking do I book some profits? Do I stay in that company? So I have some reasons behind that, and my decision for today that I'll continue to hold that stock. So I'm going to give you every single point that I consider and why I decided to get out of one company and why I decided to stick around with other company. Now, just to kind of give you a brief perspective on that, both of those companies are very profitable for me. For example, when I look at Celestica, I'm up 150% on it. So, if I sell it, no harm done. I mean, I bought it for dirt cheap. Similarly, when I take a look at Root, I am up about 90% on that stock as well. So both are very, very good. Every now and then when we discuss finances, one of the things I say is you got to reevaluate your thesis every now and then. That allows you to manage your portfolio, that allows you to make sure that you are spending enough time to better understand the company, which direction they're going on. It allows you to better align yourself with your own financial goals. So those are the kind of reasons why you need to go back and take a look at your portfolio every now and then. So please, my point is, don't buy Root because I'm holding on to it, and don't sell Celestica because I sold it. Those two would be absolutely the wrong reasons. Number one, I'm not an investment advisor, so I can't give you an investment advice. So anything that I share in this video will be purely informational purposes, nothing beyond that. Number two is you should really learn how to evaluate your businesses. Because, for example, let's say you go buy a property. Should you really take my price on it or your realtor price on it? No, you need to see how that property fits with your lifestyle. Is there enough value in it? Can you find a similar property in the market? Can you find a better property in the market? So for example, let's say if I get out of Celestica, I could have gotten out of it because of multiple reasons. Number one, maybe that trade is not profitable for me. In my case, like I said, I made 150% on it. So that's not the reason. Another reason could be is that maybe that industry is going backwards. In this case, Celestica is involved in providing support services to data centers. Are we building more data centers? Absolutely. Are we moving data centers from overseas? Absolutely. Is that industry growing? Absolutely. So that's not it either. So that is good. Another reason would be is that maybe I'm worried about something. So that could be it. Or it could be that I just need some cash. That could be another reason. Or it could be that I'm finding a little bit better opportunity elsewhere. So a lot of different reasons why we get out of companies. So don't ever sell out of business just because somebody else did. That would be a wrong move because their reasons might not be your reasons. We all live in different places for different reasons. We all do things differently for different reasons. We eat different food for different reasons. We go to a different school because of different reasons. So let's not try to copy each other and come up with our own thesis. But I'll be happy to share my thesis with you. Before I go any further, let me remind you of a couple of things. Number one, we are going to meet on March 8th. I'm going to be in Newark at the Courtyard Hotel. So if you guys want to come see me there, I'll be there in the evening. I have put aside from 5 to 7 time frame just to meet up with my clients, my prospective clients, people who want to come say hello to me and ask me your questions. I'm going to make that time available to you guys. So that's on March 8th evening from 5 to 7 p.m. Now, if you guys find a better location, I'll be happy to come there as well. So no problem. But, last time we tried that democratic process and I found it's like a lot of back and forth. So I'm just saying, look, I'm going to be at the hotel. If you guys can come up with a better place, just let me know. I'll be happy to come there. In the morning, on the same day, on March 8th, from 10 a.m. to noon, we're going to do FBAR webinar. We're going to talk a lot about foreign assets and income. So you can ask us all of your questions about your properties in outside of the country, or maybe you have an income, maybe you have a business, all those kind of questions can be answered in webinar. So on Saturday, we have a lot of time. Now, some of you guys who want to come see me in person, maybe you want to have a tax consultation, maybe you want to talk about your business, maybe you're thinking about starting a business, then I have time available on Friday, Saturday, and Sunday. You can certainly book appointments with me on those dates if you want to come see me in person. To do that, you just go to taxcodeadvisors.com and pull up my calendar from there and just book some time. Discovery calls are free, but don't do the discovery calls on Friday, Saturday, Sunday, because I want to really meet with people that time. So book either a consultation call or come to the meetup, please, on Friday, Saturday, Sunday. All right. Or all the other times when I'm not doing personal meetups, at that time, discovery calls are okay. If you want to just talk to me for 10, 15 minutes and see if we have a good synergy, then we can do that. So let's come back to Celestica for a second. What happened with Celestica? I like Celestica because, like I said, they have all the right reasons. The problem is that right now I'm a little bit worried about inflation. I'm worried a little bit about unemployment. I'm worried about tariffs. I'm worried about, people losing job. I talked to one of the person that I work with. He said he owns a lot of malls, and one of the large tenant in his mall just suddenly left without paying the rent and left all the furniture and everything there, a lot of value. So that was kind of interesting. I talked to another gentleman recently who was gambling with his money. Somebody showed him some interesting app where he can go put money in it and easily make money. And he played with a couple $100,000. So when I start to see this kind of behavior, that's what gets me worried. That means people are just taking a crazy amount of risk and things are not looking good. That's a recipe for disaster. So that's why I'm a little bit worried about it. Are we there yet? I don't think so. And I'm going to share my thesis around that at the meetup. I'll share some of the things that I'm watching out for. Now, the economy changes like that. So it can happen at any time, very, very fast, because you're just like always, a couple of hours away from another news. Who knows what Trump might say in next meeting, or Elon Musk tweet something that gets people all scared or excited. So things can go in one way or the other at any time. So I don't really like to plan my things like things are going to crash tomorrow or anything like that. But we got to be cautious. So really, that's the reason why I got off Celestica. So then you may ask me, then why didn't you get out of everything else? Very good question. So here's the thing. On Celestica, I'm already up 150%. And when I did a valuation for their cash flow based on their 2025 numbers, that means for the entire year, I came up with a number of $118. That means that should be the fair value. Doesn't mean that would be the stock price. Oftentimes, stock price is higher than a fair value. But if we do have negative sentiments, if we run into recession, then it's the other way around. Oftentimes, those prices are way under the fair value. So the way I look at it, I'm like, okay, in 2024, their earning per share was $3.74. And if I say, let's say the fair PEO of a company like CLS is, let's say 25, that puts the fair value at $94, $93. Now, I think if I'm not wrong, this morning when I sold it, it was at like 105 or something. So I'm like, okay, the fair value is 94 and the stock is trading at 105. So why not I take advantage of that opportunity? That's one reason. The other reason is I look at 2025 number. I'm like, okay, so where are they going to end up in 2025, at the end of 2025? And that number I got from CLS is $4.75. And let's say they are smart, they're going to beat that number because they're going to do some buybacks or they're going to improve their margins or something like that. Let's just say, $5. At $5, and if we assume that we certainly are heading towards a little bit of headwind and things are going to slow down, that means, let's say PE of 20 might be a little bit more fair number at that point. And even at an EPS of $5, this stock will be trading at $100 at the end of 2025. I'm able to get $106 today. So why not I take $106 instead of waiting the entire year? That's one thesis. Another way to look at it is, okay, let's just say I don't plan for recession. Let's say things are going to be good. Okay, so what will happen? Well, in that case, the fair PE will be 25 and the stock will be roughly around $100. And I'm selling it for 106, 107 right now. So maybe I can make 10, 12% on that stock next if I hold on. So my best case scenario, I make 12 to 15%. And my worst case scenario, I lose good 15, 20%. And then, when things go negative, you just don't know. They can really go negative for a few quarters and it might take me a while to come back up. So my risk reward ratio all of a sudden did not add up. In spite of the fact I like the company, I like the industry, everything looks good. Another reason is, okay, I looked at my portfolios and I'm like, okay, which stock I feel is overvalued and which stock is not going to grow as much in 2025 and which stock have the most to lose. And when I look at those numbers, Celestica, even though it's a good company, I like the company, was still on top of my list. So that's the reason I decided, perhaps it may become a good trade for 2025, but certainly not a good investment at this point. So what do I mean by that? So I'm looking at, what? I know, at least now I've done my valuation. I understand the company. I know what this company does, So I know that this company very well can go anywhere between 95 to $150 in 2025 if things are good. So if I can get this stock, let's say for $80 or $70 in 2025, maybe I'll come back to it because now I have another 25, 30% to make on that. But right now, the risk reward ratio is out of balance for me. So that's the reason why I got out. And then I looked at another one that stood out to me is the Root. And I have discussed Root as well. Now, by the way, before I go any further, I hope I reminded everyone already that I'm not an investment advisor. So anything that you hear in this video is not an investment advice. It's just my personal finance, how I make my decisions, how I think about these things. And I like to share that with all of you guys. So that way, hopefully I can add some value to you. A lot of people kind of like to save all this good information to themselves, don't want to share it with the people that they care about. But I'm hoping that if I give all my information out to the world, that will attract a lot of people back to me and I will grow anyway. That's the thought process behind that. So if you appreciate what I'm doing, if you like all the efforts that I put in, then the best compliment you can give me is to do business with me. So if you're looking for a tax professional, or even if you're not looking for a tax professional, maybe you do your taxes on your own. Hey, why not partner up with me anyway? Because I'm delivering value at the end of the day, right? And I'm going to talk about, there's a reason why I put it that way, because I'm going to talk about Root just in a second here, and I'll explain to you how they're delivering value and why I'm holding on to this company. Now, once again, just because I'm holding on to this company doesn't mean you should go buy it. You should understand the thought process behind it, and then maybe you go do your own due diligence and apply it to something else. Before I'll talk a little bit more about value and all that, but let's just take a look at the numbers first, because that's what we've been talking about. So when I take a look at Root, they become profitable last year in 2024. They were, I think, $445 million to $1,176 million of revenue. So huge growth last year, huge growth. Are they going to slow down this year? Probably. I don't think they're going to match those numbers. If they do, great. But even if they do half as good as what they did last year, that would be huge growth for Root. That's one reason why I'm sticking around with them. Number two, earning per share last year was $1.96. And this is in spite of the fact, first 2 quarters, there was no earnings. So if I do a PE of 20, that puts the stock price last year at 40, and PE of 30 puts the stock price at 60, but who cares about those numbers? Because people are looking forward to the growth Root is doing. And based on earning per share of $6.50, that's what my guess they're going to make in 2025. They might come back and surprise me because they're growing so fast. They might say, hey, it's $8 or $9. I don't know. But my estimate is for 2025, they're probably going to make about $6.50. We'll come back and review this video at the end of 2025 to figure this out, or maybe January of 2026. But my guess is they're going to do $6.50. Things might change along the way. We will find out more each quarter. But if I say, a fair PE of 25, that puts the stock price at $162. And this morning when I check, I think it was trading at 135 or something. So I look at it, okay, it's still undervalued even today. It still have another, good, I would say $30-40 to grow. So why should I take a tax hit? I'm already up 100% on it almost. So why take a tax hit when there's still more room to grow in this company? And then second reason is this is a high growth company. They might actually surprise me. Maybe they do another 100% growth and stock goes from 130 to 260. I don't know if that will happen, but it can happen because nobody knows. Sometimes people ask me, Deepak, how do you know which company is going to 10x? And the answer is, I don't know. I have no idea. When I bought Root, I didn't know that they were going to do that well, that they're going to grow from 445 million to 1176. I didn't know that. What I do is I look at the numbers and I look at the market. I look at the business model, and I'll explain to you all my reasons for Root just in a second here, so you kind of see the picture. And then I buy in a very small quantity of those companies. And I mean very small. Like I'm talking about $2,000, $3,000, like very small number. Some of you guys might be laughing like, oh, that's a lot of money. I'm sorry, I didn't mean it that way. But I'm just saying, for me, I start with very small number. And then as I start to build my conviction around that company, as I start to see fundamentals improving, as I see the company's revenue is growing, margins are strong, people are talking about them, there's a lot of good sentiments around them. I look at all that stuff. That's when I start to put more money in. So I put more money into my winners and let them grow as much as they can. That's one of the reasons why I'm not selling Root just yet, in spite of the fact I've already made 100% profit. All right. So now, so now you understand the reason why I sold one company, why I don't. Let me talk. I've made some notes here for Root. So let's talk about Root for a second. What do you call a good business, generally speaking? Okay. Is it somebody who provides you the cheapest cost? Is it somebody who has the best quality product? Or is it somebody who provides the best service, right? Let's talk about that in my own business as a tax service. Some people might not like my cost, while a lot of other people might like my cost. Some people might not like my quality. Other people might like my quality. Some people might not like my service. A lot of other people might like service. So they're going to be like all mix of all that. But at the end of the day, what really matters is what does my client or prospective client think about the value I'm delivering to them. That's what matters, right? Because, maybe you're working with a tax professional or you're doing it on your own and you go like, well, the people I work with, do they spend that much time with me? Do they teach me so much? Am I learning something new with Deepak every single time? Who else is spending that much time? So my clients come back to me like, and by the way, some of these people make millions of dollars per year. Just saying, I don't want to brag about it, but I'm saying these are smart people. That's what I'm saying. Okay, these people hold very high level executive positions in their companies. And when I sit down with them, they always say, Deepak, thank you so much for sharing all the knowledge. Thank you so much for telling me all the information that you give out. I learned a lot from you, I think that's the best compliment you can get, because now you're delivering value. Anybody can get the work done, but how many people can deliver value? When you deliver value, you can build a very profitable business, and that's what that's what I'm going to talk about for Root. Okay, so how do you build a big business? Well, one way to build a big business is you invent new products. Okay, another way is that you built a better supply chain. So I have some clients who are in supply chain. They're always thinking of ways to cut down the cost and deliver the products faster to their customers. Like, why do we all love Amazon, for example? Is it because of the price? Is it because of the service? Yeah, those two are important. But I think the bigger idea behind Amazon is their value chain is so good. And that's why that company continues to grow. All right. So what is value chain? Well, value chain is that people drive value a lot of different ways, from a lot of different segments. Like, for example, in terms of Amazon, you get value from Amazon Prime, you get value from same-day shipping, you get value from their pricing, you get value from their AWS, and so many other things they do in addition to their return policies and all that kind of good stuff. And the technology, that's awesome, right? We got all used to buying stuff from Amazon with a click of a button. So that's how Amazon drives value. And how did they start it? Well, they started at the bookstore. First step was they got rid of all the bookstores. People, habits change, they start using Amazon. Okay, no more physical browsing, no more carrying books, no more buying them at the store. All of those habits change. And Root Insurance learned that, I think, from Amazon. And if you think about a traditional car insurance business, how does that work? You have an insurance agency. That agency has an agent. That agent gets commission on that policy. So, and then you go to an agent. They ask you for a whole bunch of information. Then they go shop around with multiple insurance agencies for you. Then they find you a policy. Then they bind that policy. Sometimes they are not able to bind it because after you agree to certain terms and conditions, they go back like, oh, wait a minute, I don't agree with that risk. So there's like a lot of steps involved in buying insurance. Root changed that. They say, look, no need to contact an agent. No need to go to multiple companies. No agent needed to file a claim. You can do it all yourself online. So they made it super simple by the use of technology. And they told their customer, look, if you use us, if you use Root Insurance, we will save you a lot of time because you don't have to go back and forth with your agent to figure out what might be a good policy for you. We will offer you a digital insurance instantly right on your app. You can do everything. And they grew, like I said, from what was that number? Let me pull this up here. From 445 million to 1176. So there is, people are obviously liking it. And believe me, Root is not in the entire company just yet. So they still have, my guess is probably at least 15, 20 states they don't even do business in just yet. So if I have to make a good guess, they have plenty of room to grow. Second thing is you take a look at and you could just say, okay, what can they do with profitability? There's so many insurance companies. How are they going to survive? How are they going to beat other competition? Well, they do that because of technology. They don't have all bunch of overhead. They don't have people sitting in offices juggling numbers on paper anymore. I mean, so many insurance companies, and I'm an insurance agent, so I know this. So many insurance companies are so dependent on legacy systems even today. So when a newcomer comes in and they build a business completely digital using today's technology, it dramatically improves their profit. Traditional insurance agencies, how do they, or insurance companies, how do they figure out how much premium are you going to pay? Well, many of them look at your credit report. They look at whether you own a house or you rent a house. They look at how many accidents you have, how many red lights you have crossed, and all that kind of stuff. It's very uncomfortable to begin with when you have all that kind of conversation. But more importantly, the prices can be anywhere. Like it's just like it's very hard. On the other hand, Root uses the real-time driving app, and now you're starting to see that a lot of companies are coming up with those because people are catching up. In matter of fact, I think earlier we were talking about Warren Buffett. I shared that video earlier. One of the reasons why Berkshire Hathaway did very well in 2024, mainly because of insurance business. Go back, take a look at their financial statement. If it wasn't for insurance business, Berkshire Hathaway would not be doing that well. I don't think they would have returned 25% in 2024. Maybe they would have returned 4 or 5%. So insurance business has a lot to do with the success of Warren Buffett. By the way, that's another reason I'm still with Root. Okay. So how does Root works? They give you a little app on your phone. You drive around. They take a look at how you brake, how you turn, how you stop. They track all of that data, and insurance company decides what rate you're going to get. So maybe your rate goes up, maybe your rate goes down. So I know many of you guys say that I don't like it. Yeah, I don't like it either, but you might like the price. Good drivers get a huge discount, almost 25% discount. So some of us who maybe not drive as good and we have some bad driving habits, maybe Root is not a company for us. But guess what? You're also not a customer for Root anyway. They're not looking for you. They're looking for good drivers. Why? Because they don't want people who are going to have claims. So that's the strategy. I think the last numbers I checked, the average premium for car insurance is roughly about $2,000, and with Root is about $1,500. So almost 25% off on the premium if you are a good driver. So again, what happens when you have a lower premium? You tell a whole bunch of other people that, hey, I'm paying less than you, and that attracts more people into the funnel. So that pricing factors work. And the other thing is their relationships. Their relationships with partners. They're partnering up with big companies. For example, all of you guys heard of success story of Carvana, right? And how does Carvana sell insurance? Through Root. When you buy a car from them, you go on the checkout, and right there's the insurance app from Root, and people buy insurance from that. So Carvana sold a lot of cars last year. Are they going to sell more cars? Yeah, I checked out their letter to shareholder, and they're saying they're expecting to sell even more cars this year than they did in 2024. So that tells me that Root is going to do just fine as well. There's a lot more possibility for them. Because how many other companies is Carvana going to really partner up with? These kind of partnerships are usually long term, and there is a skin in the game for both parties. If you take a look at the market of auto industry, the US car sales or car insurance business is about $300 billion market right now. It is estimated to grow roughly around 6% per year. So, even at the bare minimum, I can say Root is going to grow at least 6%. By 2035, this market will be roughly about $540 billion. So huge market. The question is, what percentage of that market share can Root take? Even if they take, let's say, 5% of the market share, that would be huge for Root. So this stock can still go 2x, 3x from here if they're able to achieve that number. Those numbers are going to be huge. I haven't heard anything where that partnership with Carvana is dropping. In matter of fact, now agents can become Root agents as well. So even the individual agents can become a Root agent as well. So that is still a possibility. And then right now they only sell auto insurance. What is stopping them from selling home insurance or other insurance? They can cross sell into different industries. So all of that is yet to come. And like I said, they're not even in all 50 states just yet. So there's a lot of reasons for me to be excited around that. I expect Root to easily grow at least 30% per year for the next few years. And their earnings will continue to grow. Their cash flow will continue to grow. So, in summary, I have a lot of reasons to be excited about Root. And then is tariffs going to impact insurance industry? Probably not. Is inflation going to affect insurance industry? Probably yes, but I think most likely Root is just simply going to make more money because they will pass on that cost to the people. So from a business point of view, there are a lot of reasons for me to be excited about Root. So that's the reason I'm not selling Root just yet, in spite of the fact that I'm up 100% in this company. So I hope that kind of gives you a better understanding as to how I make these decisions. Now, in the upcoming meetup, I'm going to focus more on the recession, like what kind of things that I'm watching out for recession, and what kind of steps I am taking to protect myself. So if possible, please come see me in person. Let's have a discussion together. And seriously, if put a note in the group that you're coming, because if there's like a lot of people coming, then we'd better find a better spot, because that lobby in a hotel might not be an ideal platform in that case. All right, guys, once again, my name is Deepak and I'm a tax code advisor. So everything I discuss is just my personal decisions, not an investment advice for you. Certainly don't do what I did. I'm telling you, that's the only advice I can tell you is don't do what I did. Go do your own research, figure it out what you want to do on your own. Ask questions, explore, get other people's point of view, and expand your horizon. And most importantly, get ready for rainy day. That's the one advice that I can give you for sure that's going to work for you. And lastly, I'll urge you to please reach out to me, help me, support me, help me grow my business, because only then I can continue to support you guys. All right, thank you so much, and I'll see you at the meetup. Bye-bye.